Welcome back to Morning Markets on Friday the 4th of February. On screen we can see the key market moves from yesterday. In today's session I'm going to focus on two areas, the meeting of the Bank of England and the European Central Bank. If we start off with the Bank of England, in terms of the decision on the day, they agreed to raise interest rates from 0.25 to 0.5%. The expectation that a rate hike would come through was already there. However, what was interesting was the voting card. There was not a clear majority. The voting card was struck 5 votes to 4. The 4 members which were against the initial vote were essentially requesting a 0.5% increase in interest rates, taking rates from 0.25 to 0.75. This is essentially the level they would have been at pre-pandemic. Raising interest rates is one monetary lever which they've pulled. The second is around reducing the level and the amount of company bonds which they hold on their balance sheet. At present, they have around £20 billion worth of company bonds on the balance sheet, and they're looking to wind that down to zero by the end of 2023, which essentially requires them to sell company bonds. They're also looking to wind down, and this is where there was consensus across the voting members, wind down the government bonds which they hold on the balance sheet. At present, they hold around £875 billion worth of government bonds on the balance sheet, an amount which was turbocharged through the pandemic as part of the quantitative easing programme to support financial conditions. So starting to wind that back. The way in which they're looking to wind that back initially is by not reinvesting bonds which mature. This is expected to shave around £70 billion off the balance sheet over the next 2 years. In terms of the discussion, there was some interesting points. One was really that view on inflation, which we've been expecting to peak in the first part of this year. That is still the case. However, the level which they're expecting inflation to peak at in the UK is around 7.25% in April. So that's some 2% higher than that level expected back in November. However, that level is expected to moderate through the year, reaching a level of around 5% by year end and then heading towards target through 2023. The committee's view is that there is potential for these inflation prints to come down given those numbers quoted, and therefore that was giving them reason to make a modest increase in interest rates at this point in time. The decision did not focus in on the government proposed cap on energy prices. However, comments reflected that this would not have skewed the decision significantly at this stage. In terms of the European Central Bank, they've been on a slightly different tack to the UK and the US. Essentially, they've been more dovish, which just means they've had a looser central bank monetary policy for longer. However, what's interesting is we're starting to see a bit more of a hawkish tone come through. The reason for this is the inflation prints which we're seeing are hanging around a little bit higher than initially expected. So Christine Lagarde did not rule out the prospect of raising interest rates at this point in time. In terms of the reaction, we saw a material shift higher in Treasury bond yields, in government bond yields at this point in time. For context, UK 10-year government bond yields rose 11 basis points from 1.26% to 1.36%. For context, we entered the year with bond yields just below 1%. And in Europe, similar moves. If we take the German Bund as a proxy there, around a 10 basis point move, putting the Bund yield in positive territory. The move in yields and higher financing costs was felt manifest within those companies which are trading on higher valuations as analysts reappraise the value of future cash flows and therefore the valuation placed on companies. Chris highlighted yesterday the moves which we were expecting to see come through with Meta or Facebook as a result of the earnings, and sure, we did see a reaction in the share price on the day. From a currency perspective, the euro was stronger relative to the dollar as central banks look towards recalibrating interest rate levels, which have been different to one another for some time, and the pound was stronger relative to the dollar. If we think about the key takeaways, interest rates, as we've discussed, at zero bounds are not normal in a vibrant, growing, healthy economy. So we've been anticipating tighter policy at this point in time. Central banks are better placed at this point in time to raise interest rates given that backdrop. They also need to raise interest rates to build up some armoury should we see an economic growth side shock further down the line. They need armory and levers to pull to stimulate the economy. They also need to manage inflation in line with those targets. And what we're seeing from central banks is they are acutely aware of inflation expectations and current levels, and they are agile, they are working in a way which is supportive of meeting inflation targets whilst not choking off economic growth. Thank you very much for watching today. We look forward to bringing you up to date through the week here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.